This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Important disclaimer, this podcast material is for information purposes only. Simplicity does not provide financial advice or offer insurance products. Simplicity is not affiliated with Partners Life or any other insurer, and we do not provide recommendations or referrals. Welcome back to Money Made Simple and back to our two-part episode of insurance. Welcome back, Mark.
Thanks for having me, Liv.
Really appreciate you being here. Let's dive straight into the episode. So let's look at who needs insurance. And this is a really general kind of state of the world. Like, is there a particular age or stage or wealth level that you should have insurance?
It's a great question. And for my part, I've mentioned in the first episode that the concept of insurance is things can happen to you in your life that you don't have the cash to deal with.
Yeah.
And insurance is there just in case that happens. And so anybody who has a risk that something might happen to them that need a bit of a pool of cash to help them get through that issue, insurance is suitable for that. On that basis, and as you've said, we're not in a position to give personal advice. My own children, when my children reached about 10 years old, I jumped in and got some life insurance for them.
So you can get insurance at any age. Are there particular types of insurance that you should have at different ages or stages?
I think it's probably a good point to talk about the different types of insurance cover that exist.
Okay.
And then an advisor is the best person to sit down with an individual and say, this is the type of cover that you need. You were talking about jargon in our previous conversation. And part of the complexity in our industry is different companies call these things different things quite often. So I will use some alternative names. The most obvious one is life insurance or life cover or death cover in some cases. So life insurance is if the life insured dies, you get a lump sum of money.
Okay.
In
a nutshell.
In a nutshell. That money is often used for a funeral for a starter. If it's a husband or wife that dies, then it may be used to repay the mortgage. Sometimes an advisor will recommend you get a pool of money to pay for education for the children until they reach age 18. So it can be a large sum of money to pay for all of those things so that the family that's left behind can be looked after.
And they don't have to specify what they're going to spend that money on, right?
No, there's no requirement to do so. So that's life insurance. The second major one has got an awful name. It's often called trauma insurance, critical illness insurance.
Just as bad name?
Just as bad. When it was first introduced in 1983, it was called dread disease cover.
Wow.
This is also a lump sum insurance. And this policy has a list of different health conditions that can happen to somebody, and it's quite specific. And quite often the medical definition can differ from the contract definition.
Okay.
For example, if you have a heart attack, well, what does it mean to have a heart attack? So the doctor may say, you've had a heart attack, but if you go back to work on Monday, you don't really need the insurance money. So the insurance contract will often be worded in a way to say it's got to be a severe enough heart attack to warrant.
Is that one of the reasons that life insurance policies are so long and detailed?
Yes, and they also contain a lot of technical language because these terms have to be defined in a medical way.
So you don't want to leave any grey area in the instance
Ideally
of a
not.
claim?
Yes.
Okay.
So trauma cover or critical illness will cover things like heart, stroke, cancers, but they are specified conditions.
Yes, and in the same vein, there'd be lots more conditions that it doesn't cover. So read your policy if you ever have one or get one.
Yes, and this is where advice is really important because some policies will cover fewer conditions than others.
Okay.
So that's the second type, trauma insurance. The third type, which often these days is written into trauma policies or critical illness policies, is called TPD.
Sounds like a disease.
We love three-letter acronyms. Total permanent disability.
Okay.
This is essentially where something happens to you, whether it's health or injury-wise, that means you can never work again. The policy will often be either an own occupation or any occupation. So if you, for example, are a doctor and you cannot work again as a doctor because something has happened, then if you've got an own occupation, you get paid out. But if you've got any occupation and you could do a desk job, then
it won't pay out.
It won't pay out.
Oh, interesting.
So
the
own
technicalities.
versus any occupation is very important. But again, that's a lump sum. So if you're TPD'd, we say if you have total and permanent disability, then you get a lump sum of money again, the cover amount of the policy. So that's the third type. The fourth type is called income protection or disability income or these sorts of things. Now, the first three types that I mentioned, life, trauma and TPD, are lump sum payouts. Income protection is a monthly replacement of your income.
Okay.
And it will generally cover a portion of your income. You won't
Won't be 100%.
It won't be 100%. Otherwise, why would you go back to work?
True.
But it's usually about 75 or 85% of the income, depending on tax implications.
Mm-hmm.
So if you're unable to work, you then get your monthly income paid by the insurance policy up to the period specified in the contract. And so you can get an income protection policy that covers you for 2 years, or an income protection policy that covers you until you are 65 years old.
Are those the only two options?
No, there are options in between as well.
So you could talk with the insurance provider or advice professional.
So it's a matter of risk. Generally, if you are unable ever to work again, having a replacement for your income for your working life is tremendously valuable.
But it would be a lot more expensive, I'm assuming, to get that to 65
Absolutely.
cover.
It's more expensive to get it to 65. So yes, advice is really important there. So that's a fourth type. And the fifth type that we could talk about is health insurance, which people are more familiar with. And health insurance will cover you for specialists and tests. Sometimes that's often an optional extra. It's often not part of the core policy. They'll cover you for elective surgeries and those sorts of things. It'll mean you can choose to go to a private hospital rather than waiting for the public system. So it can reduce the amount of time that you take to get medical attention. So there's some of the main things. And a lot of people in New Zealand will say, I don't need this kind of cover because we've got ACC. Well, Accident Compensation Corporation covers you for injury.
That's it.
Doesn't cover you for health condition. So if you, for example, have a melanoma or any other condition that it means you're unable to work, or some sort of degeneration in your knee that's just happened through old age and wear and tear, ACC won't cover you for that. It covers you for injury or something that happens.
So that's where your health insurance, if it's covered, comes in.
Yes.
And again, there'll be specifics in your health insurance depending on the level of cover and the type of cover that you take out, right? It's not just a general cover-all.
Yeah, and this is actually also true of general insurance, that not all policies are the same, and this is where advice is really important. So the benefits in the policy aren't always the same, and getting advice on these to understand what the different risks are and what you'll be covered for and what you won't be covered for, it's really, really important.
And very personalised to you.
We're just talking generally about what insurance is.
One more that I think is quite similar but not the same to income protection, something that I've actually had, is mortgage protection.
Yes, glad you raised this, because insurance companies over the years have come up with a large number of slight variations of these products, which they call under different names. Mortgage protection generally is designed to be like an income protection product that will pay an income over time, and it's really just the same kind of thing under a different name, which will have slightly different benefits to change the premium option. So sometimes mortgage protection can be a little bit cheaper than income protection because it doesn't cover you quite as much.
No, and it will be a specified amount rather than a proportion of your income, won't it?
Yes, we have, for example, at Partners Life, we have one called mortgage repayment cover, which is like an income protection product. But I think there are also some mortgage cover products that are more like a trauma or critical illness product that will pay a lump sum.
Okay. Now that we know those really common types, and there are a whole lot more types, right, that are worth talking to with your advisor when you do look into these types of insurance, and if there are others that would suit your personal situation, we're just covering the really common.
And if you are talking to a broker, just push them a little bit and say, I want some advice. I want you to tell me, why is this policy different from this policy? Explore those options.
That's a really good point, though. I mean, I think there is a bit of a stigma around the insurance industry and brokers or advisors that people think that they're being oversold or are going to just be sold a huge amount that they can't afford. Is there a way to kind of tackle that?
Yes, there is. And I guess the first thing to say and answer this question is that we are generally underinsured as a nation.
Oh, really? So rather than overinsured. So people's worry, it's actually the opposite.
Absolutely. Generally, most people are in some way underinsured. Even in house insurance these days, you may recall that after the earthquakes, insurance changed the policy wording so they weren't just replacing your house, they'd cover it to a certain value. There is a tendency for us to be underinsured. If everyone were able to get the optimum level of insurance to cover them for all their risks, it would be very, very expensive. So it's more likely that people are trying to get the budget right of the amount of money that makes sense for their family to spend. And it will probably feel uncomfortable when that happens.
So how do you determine how much cover you need and maybe what types of insurance that are right for you personally?
A great question, and the best answer to that is seek advice. It is a difficult area. It's great to have an understanding generally of what's available so that you can ask good questions to your advisor, but it's a very difficult area to say, well, how much money would I need for my family if I were to die tomorrow?
That's a hard question,
It's a really difficult question. How much money would I need if I had a heart attack and was off work for 3 months?
Or had a heart attack and was off work for 3 years. You don't know what's going to happen.
That's right. And so you don't even know what the risks are. So the best answer to that question is seek advice. Talk to a few different financial advisors and find one that you're really comfortable with, that you just have the right vibe with. There are advisors in New Zealand of all different cultures, of both genders, of different age groups, different communication styles. One of the other things I think it's really important to tell people is insurance is not a one and done. You don't get life insurance advice and that's it. I've got life insurance now.
I'll never have to look at it again until after 65.
That's right, because in 5 years' time, you'll be in a different job. Your income will be different. You might be in a different house. You may have extended your family. So a good advisor will be contacting you every 12 months or something and saying, hey, look, has anything changed?
Yeah.
And it's things like your family circumstances and your financial circumstances.
Talk to the professionals. And on that note of talking to the professionals, how does the advice process kind of work?
It is generally a very personal process. So the person that you meet with, you'll sit down and talk to, and they're going to ask you a whole bunch of really personal questions. Because as we talked about last time with this concept of underwriting, the insurance company has to understand what is the nature of your risk. What's your health situation been like? What's happened to you in the past? So what is the history of health in your family? So a lot of these are really personal things. So that's why you really need somebody you're very comfortable with. And so in the first meeting, they're going to ask you a whole bunch of these questions. They'll ask you about what are your objectives? What are you trying to achieve with insurance? What do you think the needs are if something were to go wrong in your family? We call that the needs analysis, understanding the needs of the client. They'll often then go away. They'll do their research, they'll look at the different products in the market, try and get an idea of what's right for you. And now in that first meeting, they'll give you some important information about how their business works, about who to call if something goes wrong, about what companies they deal with.
So a bit of kind of transparency around.
Yeah, there's some legislated disclosure, so some things they have to give you. So they've agreed their scope, they go away, they do their homework, and then they'll come back to you and say, I've done my homework, this is what I recommend. And so at that point, they might give you 2 or 3 different options and say, here's some different ways that we can price this to try and make it more affordable. Here's some different options for different companies. And then the two of you negotiate it and agree.
Those options could be both the different providers and different structures within different providers.
Different structures, yes, as well.
Okay.
Yeah. Cool. And then the next phase is the application process. And often the advisor will help you with this as well because those questionnaires can be quite challenging. And so they'll work through the application process. It goes to the insurance company. They do this magic underwriting thing where it goes in the black box and they understand your risk. And they'll come back to you with what we call an offer of terms, which is where they look at exclusions and loadings and say, yes, we'll offer you cover, but we're not going to cover you for your base jumping because that's a bit scary. It's really important when you're talking to your advisor to tell them everything.
That's a really good point.
Yeah, under New Zealand law at the moment, anything you don't tell them is your fault. So be really, really open with your advisor, and you don't tend to know what the underwriter wants to know. You might say, I fell off my bike when I was 10 and hurt my shoulder, and it's always been a little bit gammy since then. Well, that's something you probably want to tell them, and the underwriter will determine whether or not they want to know that.
Would the same apply for your family history? There could be some health issues in the past that you didn't know about. How does one...
You can only tell people what you know. The best I can say is just do your very best to give the advisor the information that they can, and they'll give you advice on, personally, I'm in this position. My paternal father, I've met once.
Yeah.
I don't know his history.
Yeah.
So,
Makes it
your advice
challenging.
can work with that sort of stuff.
But I guess the point here is there is no point in covering up things that you think won't help your insurance offer.
Absolutely.
Because it's probably not likely to help you in the event of a claim.
Yeah. What often happens in the event of a claim is that the insurance company will just take a look. They'll maybe dig into your medical history and just make sure that there's been enough that you haven't told them. And if that happens, then they'll say, look, I'm sorry, you should have told us this, and now we can't give you the cover. So be honest.
And in terms of that, that's a great segue into the claims process. There'll be a load of people who haven't made a claim before. It sounds probably like a scary thing, and that the insurance provider is just going to try and not cover you if they can. I've heard it plenty of times. It's probably a really common state of mind in terms of being,
It is a challenging perception, isn't it? What can happen in the consumer experience is we haven't read the detail of the contract because they're very legalistic documents. However, if it's within the terms of the contract, the client's going to get paid. The challenge sometimes is in giving the insurer the information the right way, providing the right information. If you have an advisor, often they will give you claim support. So if you have got an advisor, they can often field off the real obvious stuff to say, look, that's not a claim. If you can call the insurance company directly, but often the advisor is a really good starting point. And they'll go to bat for you also in the hard cases. The ones that are a little bit grey, often the problems happen on those real edges of the definitions, and an advisor can be the sort of person to say, no, this is in, pay it. And they can,
so making a claim might not be as hard as it sounds or fraught.
Yeah, quite often. There will be, of course, the production of documents. If you've been in hospital for something, then they might need to see the records from the doctor or all those sorts of things, quite often. But the process exists to pay claims. In life and health insurance, we're dealing with people that are going through really difficult times quite often. And so the people that are on the phone will be really understanding of what you're going through because they deal with this on a regular basis.
It is their job to deal with it.
They're really empathetic and really nice people to deal with.
So it might not be as scary as you think.
Hopefully it won't be as scary as you think.
One of the reasons that we did this podcast is the cost of living is really high at the moment. Paying for insurance can be a really tough thing to consider when you are struggling to meet your general bills and food and rent and all of that. Have you got any thoughts or tips on ways to, in general, balance the high cost of living with your insurance costs to make sure that you're adequately insured but not overpaying?
Very much. And yes, we've got to be careful here. What I'm saying now is not advice for anybody in particular, and seek advice is the answer. The problem that we often see is that people will look at it and go, wow, that's a lot of money, and cancel it. And that's, I would suggest in most cases, the worst possible outcome. Because you bought this policy for a reason. It exists to be there if you need it. And as soon as you cancel it, it's not there if you need it. There are often ways that you can make your policy more affordable by doing things like wait periods, excesses, modifying your cover amount so that the spend on your premium is lower to make it more affordable. So
there are levers that you can kind of pull rather than cancelling.
Yes. So call your advisor and say, I'm having trouble paying for this. How can I make it more affordable? If you're not working with an advisor, call the insurance company directly and say, help me. I need to make this more affordable. I can't afford this. Because insurance companies don't like losing clients.
No,
so
makes sense.
We'll bend over backwards to try and make things as affordable as possible.
When we were talking about the cost of living in a previous podcast, it's something that is happening. People are cancelling insurances because they feel like they can't afford it. So.
It is, and there was a case in the paper last year of a woman that unfortunately cancelled her policy and then subsequently a couple of months later was diagnosed with breast cancer and came forward with her story not to try and say, hey, look, the insurance company's done me wrong, because they hadn't, but to say, don't do what I've done. Be really, really careful with this because it has got a job to do and you never know when it's going to hit you. Life insurance tends to increase in price more than fruit and vegetables.
Right.
And the reason for that is you've actually got 3 increases that are happening every year with most life insurances. You get the same increase as your fruit and vegetables. That's cost
Inflation.
Increases. It's just companies going, our costs are higher, we have to pay our staff more, so we've got to put our prices up. That inflation type cost. But the other thing is, particularly with your lump sum covers, if you have $100,000 worth of life cover, because of inflation, in 10 years' time, you can't buy the same amount of things with $100,000 as you can today. So what you'll generally want to do is increase your cover amount by inflation.
So how much the actual amount that you're receiving in the event of the claim is?
That's right. You want that to go up as well so that it can buy you what $100,000 today can buy you. So as well as getting your price increases because of cost, you're also having to increase your cover amount and pay an extra premium for the cover amount. It might go from $100,000 to $103,000, or when we recently had a spike of inflation, $107,000. So you've got a second price increase for that. The third one is, as we get older, the risk of things happening to our health really goes up, and so your premium increases quite significantly as you age.
Yes.
You know that when you're in your 70s, there's a lot more chance of things going wrong with you than when you're in your 20s.
Yes.
So. We call this a yearly renewable term, or where you're paying for the age increase as well. And so your premium will start about here and then kind of do this as you
Oh,
go
it's like
older.
an exponential curve, like in
Yeah.
compounding returns.
Now, there is a type of policy that can take that age increase out. It's called a level premium. And so you may still get the cover increases and maybe the price increases
From the inflation.
but your age-related increases, what it does is it tries to level them out and say, okay, well, if you hold this policy until you're 65 or 70 or 80 or whatever it may be, rather than increasing your premium for your age every year, we'll just kind of level that out.
Okay.
So you'll pay more when you're younger, but a lot less.
Okay, so there's all types of ways to structure it.
Yeah, so the difference between level premium and increasing or yearly renewable term is quite significant, and it's worthwhile talking to your advisor about that.
Very wise words. Okay, let's wrap it up there. So we've talked about the main types of personal insurance. In terms of seeking insurance or advice around insurance, that's very much personalised, and we recommend talking to a professional and shopping around, as you said, Mark. And biggest thing is don't just ignore it. And it's one of those annoying life admin things, but you're likely to be glad that you did it down the road, right?
Yeah, very much like your investments, and you're right. It is easy to put it off to tomorrow.
Or next year or next life.
Yeah, set some time aside in your diary, lock some time out and say, we're going to get this sorted.
Yeah, and it might be uncomfortable and niggly and annoying, but one of those things that's better to get done.
Yes,
Great.
absolutely.
Thank you so much, Mark, again, for coming to join us and trying to de-jargonise. Is that even a word? De-jargonise. I'm going to make it a word.
Oh, the Retirement Commission has used it, so I'm sure.
Okay.
Yeah.
De-jargonise insurance and helping us understand a little bit more around the basics. So
Thank you, Liv.
appreciate it. And we will catch our listeners next time. The information provided and opinions expressed in this podcast are intended for general information only and not personalised to you. These materials do not take into account your particular financial situation or goals and are not financial advice or a recommendation. This podcast is not intended to convey any guarantees as to the future performance of any of the investment products, asset classes, or capital markets mentioned. Past performance is no guarantee of future performance. Information is current at the time of posting and subject to change without notice. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit our website simplicity.kiwi.